Hello and welcome to Market Matters, our monthly podcast bringing you big picture insights from leading investment specialists, exploring the opportunities, challenges, and potential threats shaping portfolios. And there's certainly been plenty of the latter over the last few weeks. Our guest today is Charlotte Morris, co-manager of the Pantheon International Trust, which provides exposure to more developed private equity markets in the US and Europe, as well as the growth opportunities in Asia and emerging markets. Charlotte joined Pantheon in 2006 and has extensive experience in asset management. Charlotte, many thanks for joining us today.
Yeah, happy to be here. Thanks for inviting us.
So could you start off by talking us through your background to becoming a fund manager? What initially drew you to the industry, and are there any challenges that you faced along the way?
Yes. So I studied maths for my sins at university and graduated pretty unsure actually about what I wanted to do. I joined a venture capital fund of funds, originally as an accountant and finance manager, but it was a really small company. And I had the opportunity to get involved in pretty much everything that they did. And so I learned the investing side from there. I moved to Pantheon, as you said, nearly 20 years ago as part of a secondary transaction, actually. And I've spent most of my career since working on private equity secondary deals. Pantheon's investment trust, Pantheon International, that's been trading on the London Stock Exchange since the late 80s. So it's been a key part of Pantheon the whole time that I've worked here. But until a year or so ago, my main interactions with the trust were actually just in sourcing and executing secondary deals that it invested in. But last June, I became co-lead manager. And, it's certainly been an interesting and challenging time over the last 9 months or so. I think what I found most challenging throughout my career has actually been less about the sort of move to become a fund manager. And obviously for me, that is quite recent. But more just generally in finding the right work-life balance, especially now I have quite young children. I think it's difficult to be working full-time and be a mum full-time. And that's probably a struggle that many will be familiar with.
Absolutely. I'm sure the number of people can relate to that particular challenge. We've seen a lot of turbulence in markets over the last few weeks, as in the words of one commentator, Liberation Day has turned into Annihilation Days, and we've seen US equities in particular taking somewhat of a pounding. Do you think that the recent falls may prove a short-term overreaction or perhaps a broader shift in the unwinding of US exceptionalism that we'd already started to see early signs of?
I think Trump's original announcement on tariffs saw a lot of market commentators and analysts raising the probability of a US recession and lowering GDP growth forecasts. So certainly that initial reaction was quite significant. The subsequent changes, is the 90-day pause, that's led to a bit of a recovery in public markets, but really the impact of uncertainty remains. And we're all pretty unclear what the future position will be on tariffs. So high level, I think they do suggest a more challenging economic environment, in particular in the US. It is just too soon to figure out what the full impact of tariffs is going to be. I think it's probably kind of late 2025 and maybe even early next year that you start to see really observable effects and see what's going to be long-term or not. You can't get away from the fact, though, that this whole period has created a lot of uncertainty, and that is likely to weigh on market sentiment. Although there might actually also be some opportunities that we can find within that dislocation. I do think the market volatility has already put pressure on exits, and we've already seen a couple of high-profile planned IPOs being paused. So the sell-off in public markets has an impact on valuations. And our approach emphasises company-level due diligence, and we certainly will continue to prioritise high-quality companies, businesses that have strong balance sheets and hopefully a better position to withstand economic volatility.
So staying on the topic of private equity, it's often pitched as a compelling long-term allocation for investors beyond public markets. Why do you think investors should consider an allocation to private equity? And do you see private equity as a fundamentally different asset class to quoted equities, or simply a different style of investing?
Any investor, whether that's an individual or an institution, should think about building a portfolio with an appropriate level of diversification. And I suppose one axis of that is between public and private investments. There's a huge swathe of companies only available through private investment, especially as the last decade or so has seen a trend emerge of public markets shrinking, private companies choosing to stay private for longer. But as you sort of alluded to, the style of investing is fundamentally quite different. At its core, private equity involves active management. So not just in terms of stock selection or choosing the private companies to invest in, but also manifesting the level of engagement with a company, an active involvement that a private equity manager has in driving growth and creating value in a lot of different ways. So growing top line, making procurement more effective, professionalizing the processes, but all ultimately helping the company to grow in a more efficient way. And a big difference actually is that private equity managers will hold companies for several years. So that allows them to invest in growth without the scrutiny of the kind of quarterly reporting cycles that public companies typically operate within. So that means that private equity, in my view, has the potential to generate outperformance relative to quoted equities. So can overall boost the return potential of an investor's portfolio.
And following on from that, what do you think allows private equity managers to deliver such consistently strong returns, especially over the longer term?
I think it all comes down to that active management. So private equity managers have full control over the businesses they own to generate those strong returns in typically three main ways. First, they're targeting growth, both in the revenues, and that might come from winning market share or growing into new markets, but also growing profits, so improving the way that the company operates. There is a second element around debt. So most managers use some level of debt that can help augment returns. And often it's the largest managers that tend to use more debt and rely on it a bit more for a meaningful part of their returns. And finally, the last element is if a manager does successfully grow a company and turn it into a better run organization, a buyer of that company might be willing to pay a higher price because the company is stronger. It's better set up for further growth. And the larger scale of a company may lead to a higher valuation. And that isn't just a case of a manager benefiting from a rising market, but a buyer recognizing that an improved company with a stronger financial profile should be valued at a higher price. So behind all of that, though, the experience and expertise of a private equity manager are critical in their ability to generate those strong returns. And the best private equity managers have deeply experienced teams, they've owned and managed many companies, and can apply what they've learned in the past to future deals.
Yeah, very interesting insight into some of the drivers of returns. There's been some debate over the democratisation of private equity in terms of opening up exposure to retail investors. Do you think that private equity can become more accessible, or do current discounts suggest that perhaps retail investors and wealth managers still struggle to understand or indeed value it properly?
It's such a great question. Pantheon has pretty much always held the view that private equity should be accessible to all. So we were established in 1982. 5 years later, we listed Pantheon International and provided a means for any individual, a small investor, a large investor, to get exposure to private companies. And there are a number of other private equity trusts that have been around for decades too. So the democratization of private equity has a much longer history, actually, than the wave of semi-liquid structures in particular that we've seen recently. But you're right, across the private equity investment trust landscape, the discount that the shares trade at relative to the net asset value is pretty wide currently. And part of that is appropriate in that it relates to the liquidity that public wrapper gives what is otherwise an illiquid portfolio. But the discounts recently have reached levels far beyond that liquidity discount. So there's been a skepticism, as you pointed out, about the valuations of private assets and a perception that they must be inflated because they haven't moved in sync with public markets. We obviously disagree with that. We have a view into the portfolio. We can look at the underlying companies and see how they're performing, but there just is an inherent lag in private equity valuations because they're typically only updated on a quarterly basis. And the information that's available is much more sparse in relation to private portfolios. So that is quite a challenge. And there are certainly some misconceptions about private equity, how the managers value their companies. But it is inherently a bit more of a sort of art in private valuations than it is a science, because really what matters is the final valuation, the price that someone is actually prepared to pay when they buy a company, and not the kind of valuations that are being marked in those quarterly periods in between. So I guess part of our job with colleagues across the investment trust landscape is to try and be more transparent and provide some of the tools and the information for retail investors, wealth managers, frankly also institutional investors, any market participant, to be able to assess investment trusts with a private equity focus. And I guess in my view, that is a little bit of a process over time, but it doesn't mean that private equity should only be accessible to large institutions.
So staying on the topic of discounts, what in your view will be the key catalyst for narrowing the wide discounts we're seeing in the listed private equity space?
Yeah, that is the $1 million question right now. And, a little bit is kind of gazing into my crystal ball. But there are some things that I think can really impact the discounts. So part of why discounts widened a few years ago was that disconnect with valuations. So I think as you start to see activity pick up in private equity, that's new deal activity as well as exit activity, we should start to see a bit more confidence in valuations. Linked to that is distribution. So what we experience in our portfolio is when a manager sells one of their companies, they typically generate a higher price at exit than what they have been marking that company at in their interim valuations. So we see that, on average, it's about a 30% jump that we have seen across our portfolio historically. So when you start to see a higher level of exit activity, so more companies being sold, there'll be two effects. One is that I think it gives more confidence in the valuations, because you're seeing that not only was that valuation reasonable, but actually a manager exceeded that valuation. But also it comes through in the NAV performance because you're seeing that valuation be crystallized in exit activity. So if you get distributions picking up, we're tracking at sort of about half the historical levels that we've typically seen in distribution. So as that starts to get back to more normal activity, I think that helps to build confidence. There was some stability starting to return at the beginning of this year. And I think, across the market, there were expectations that 2025 would start to see a return to more normalized activity levels. That has sort of seen quite a large bump in the road with the sort of public market volatility over the past few weeks in particular. But over the medium term, I think that return to a more normalized environment is important. But also it's about increasing demand for the shares and increasing demand for this way of participating in private equity. And there's one other thing that I think specific to investment trusts could help there, and that is around cost disclosure, that I think particularly for wealth managers has been quite a challenge, whereby they've had to disclose quite high cost figures for private equity when actually those costs are already implicit in the NAV that we publish, because they're all deducted before the NAV is calculated. The FCA announced forbearance in September of last year. We've been in a little bit of a limbo period through a consultation. But I think once we have some more certainty there around the cost disclosure regime going forward, I think that will help wealth managers to present investment trusts as a compelling opportunity and again, stimulate more interest and demand for buying shares of investment trusts.
Yes, it would be great to see a resolution of the issues around cost disclosure rules for investment trusts. Some critics in the media argue that private equity's outperformance is largely down to leverage and that there's no genuine illiquidity premium. Do you think that's a fair assessment? And why do you think private equity attracts so much scepticism from the financial press?
Well, the use of leverage within private equity varies pretty widely across the different stages and managers. So I don't really agree with the generalization in the media that leverage is the main reason for outperformance, especially if you look at the smaller end of buyouts. Those managers tend to be quite cautious actually about the level of debt that they use. Often the valuation multiples are lower at that end of the buyout spectrum. So that provides a natural restriction on how much debt can be used. So we do typically see managers in that part of the market use less debt. And their returns, therefore, tend to be driven actually by the core skill of private equity that I talked about before. At the larger end, you see more of a component coming from leverage. It's much harder to maintain a very high growth rate on a multi-billion pound company than it is on one that is much smaller and maybe has lots of low-hanging fruit that you can go after to grow the business and make it a bit more efficiently run. I wouldn't say it's the key source of returns across the market. But those large and mega buyout funds tend to be the groups that attract the headlines, whether it's for the debt levels on their companies or for some of the companies where things haven't worked out. I think the media likes a big story. And I think they tend to focus more on the big failures rather than the big successes, perhaps because they're smaller businesses that aren't the kind of household brands that readers would be familiar with. I think whatever the reason, though, we have some work to do within the private equity industry to highlight more of the good that can come from private ownership and better articulate how different parts of the market help companies to grow and be successful.
So, moving on to investment strategy, what are some of the key attributes you look for when you're evaluating private companies for investment?
We invest with many of the best private equity managers in the world. Pantheon International invests into companies alongside these managers and via funds raised by those managers. And about 55% of the portfolio is in what we call direct investments, where we're selecting a private company to invest in with a private equity manager who will set out how they expect to generate a return on that investment and the expected period they'll hold the company for before selling. So these are generally well-established companies where they still have some room for growth. We target companies that have some element of defensiveness to them so that when the economic environment is more difficult, like it is right now, our portfolio is positioned as well as it can be. So we don't really try and time the market and invest in cyclical businesses over the right sort of periods of the cycle. In practice, what that means, finding companies that are a bit more defensive or resilient, is often companies that are offering a product or a service that is essential for their customers. And that often translates into high recurring revenues, high customer retention rates. Technology more broadly is an attractive sector from our perspective with some of the trends that we think are here to stay. So digitalization and automation are two of those. So we look for these well-established companies that are stable, growing, profitable, usually with strong market positions, often operating in sectors that have long-term tailwinds or secular trends. Another good example of that is in healthcare, where we like to invest behind themes such as aging demographics and the need for better healthcare products, services globally.
With interest rates stabilising but remaining elevated, how are private equity managers adjusting their approach approach to deal making and also capital structures in this higher for longer environment?
Well, when you look at market data on valuations across the market for buyout deals over the last 5 years, you start to see a pattern emerging into how managers are adapting capital structures to address the elevated interest rates. So essentially, valuations have come down a turn and a half over the last couple of years, but the equity component of a deal has remained quite consistent. And therefore, the debt has been falling by that sort of turn to a turn and a half. And when the cost of debt is currently higher than it has been and is expected to remain so for some time, and likely for the kind of 4 to 6 year hold periods that managers typically target, they're using lower levels of debt to finance those acquisitions to make sure that they're being prudent and building in a bit of a buffer. We've already started to see spreads narrow, and that can also factor into managers thinking around a refinancing package and what's appropriate for a company to manage. Beyond the capital structure, we've also observed a flight to quality across our private equity managers, really focusing on companies that have stronger financial profiles and are better positioned to withstand further market volatility. Even if interest rates have stabilised and people assume that they stay higher for longer, there's still a lot of uncertainty in the market, more so given everything that's happened in the last couple of weeks. So I think private equity funds typically have, 5-year investment periods. So there's some pressure for funds that are nearing the end of their investment period to continue closing deals in this environment. And we've observed that managers are looking for those companies that have demonstrated that they're able to persist despite many bumps in the road.
I also wanted to touch on IPOs. Do you think muted IPO activities helped or hindered private equity investors? So I guess on the one hand, it allows companies to stay private for longer. That could potentially have a benefit in terms of value creation. But on the flip side, does it also present challenges when it comes, for example, to exit routes and valuations?
Well, the trend of companies staying private for longer has been observed over a longer period than the last few years, where the IPO market has been muted. So I wouldn't cite that as a reason for companies staying private for longer. In my view, private ownership is a more attractive model for many companies and their stakeholders. And as private equity funds have grown over time, there are more options now for companies to remain privately owned, where in the past they may have had to have gone public for a private equity manager to be able to actually exit that company. For us, interestingly enough, IPO actually is only the exit route for only about 7 or 8% of our exits. It tends to be the companies at the very large end of the size spectrum that really rely on the IPO market for exit, while smaller or medium-sized companies can be acquired by a larger player in the same industry or in an adjacent industry, hoping to expand maybe horizontally. Those sorts of strategic buyers will often pay a premium for the right company, especially if it's considered a scarce asset. And those smaller companies are also the hunting ground for larger private equity funds, who are often looking for well-run businesses where there's potential to grow further. So broadly speaking, private equity managers aren't forced sellers. They can afford to wait until they feel the market conditions are right. What has been challenging for exits in the past couple of years has been that M&A markets, like IPO markets, have also been subdued, in large part driven by a gap in valuation expectations, as you point out, between buyers and sellers. And the muted IPO market does reflect broader sentiment. So all those elements have kind of come together and led to lower levels of deal activity overall. I think at the end of last year and coming into the beginning of 2025, we had started to see some signs of activity picking up as certainty was beginning to return to the macro picture, but the volatility over recent weeks has really set that back. And I think we'll need to see where the picture lands with tariffs in particular and whether stability starts to return again, because that is essential for a recovery in exit activity.
And one last question, if we may. Looking across the private equity landscape, which parts of the market do you find most interesting at the moment?
So Pantheon focuses on the mid-market. So that is the smaller end of buyouts. So if you think about the thousands and thousands of smaller companies operating around the world, our view is that you need to partner with the best managers to access those companies and identify the most compelling opportunities within that broad set. In the mid-market, the dispersion of returns is actually quite wide. So for us, the key is really finding the managers that have something different. And for Pantheon, that means specialists. So either in a specific country or a region where language skills, understanding the local culture, having a strong network are all key to success. I mean, that's particularly relevant in Europe and Asia, where you have a number of different countries making up those regions. Less relevant in the US, but specialists for us could also mean particular sectors or subsectors. So I mentioned healthcare and technology as two of our favourite areas to invest. In those industries, knowledge of what are the most attractive trends, what are the tailwinds that you can truly invest behind, and investing with these top performing managers that have specialist expertise should help us to maintain our kind of all-weather portfolio that we have and continue generating strong returns.
And that seems a very positive note on which to end. Charlotte, many thanks for joining us today.
Absolute pleasure. Thank you.
If you'd like to read more market insights, please head over to the Kepler Trust Intelligence website, where, amongst other things, you'll find recent articles on the likely impact of tariffs on China. Thank you very much for listening, and we hope you join us again next month.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.